Yes. Yes. Hello, mic test. Can? Uh, can everyone hear me clearly? Can? Okay. Yep. Great. Thanks. Okay. Good morning to everyone. Thank you for attending today's webinar. So I'm Lin Xin, your macroeconomist for Asia X Japan. So today we'll be going through some updates on the China macro, and also just to give a brief recap on what happened last week, and also a brief summary of what to expect for this week. Okay. For the China stock market, this is actually the Shanghai Composite Index. As you can see that reforms and stimulus measures, meaning that liquidity has been driving the equity market instead of the fundamentals. In the fundamentals end, we are actually seeing a slowdown in China economy. Later on, I will bring you through the fundamental side. And you can see that the stock market has actually rallied quite a bit. It has become more expensive as compared to earlier of the year. Shanghai Composite Index has is actually trading at about 25 times of its reported earnings, while Shenzhen, which the index I did not show the chart, is actually trading at 75 times of its earnings. So as you can see that earnings have been weighted has been weighed on by reforms on this light blue line, and we are continue to expect that it would continue to put pressure on earnings. So on consensus forecast earnings growth for this year, it will be about 28.8% growth, but with downside bias. So that will actually translate to a forward PE of about 20 times. So in that sense, as mentioned earlier, that the Chinese equity market is actually driven by speculation. So in that sense, H shares appears to be more attractive as compared to the A shares. This is actually a chart for AH Premium Index. As you can see that it has been reaching at about 135 points, meaning that A shares are actually trading in premium as compared to the A shares. So H shares is more attractive in valuation term as well as fundamentals, as it's more stable as compared to the A shares. Okay, just to give you a brief overview on how is the Chinese economy faring at the moment. So this chart is actually representing the economic growth. As you can see that the Chinese economy has been slowing down, continue to slow down to a quarter of decade low at about 7%. And and a lot of people are actually speculating that it might miss its target for this year, and we might be looking at about 6.8% rather than on the 6.0%. And we would continue to see slowing growth, mainly due to reforms, cooling housing market, overcapacity issues, and as well as the high levels of local debt. Okay, these are the few drivers for the Chinese economy. On your top left chart, sorry, is the PMI chart, the official PMIs, which actually will show you a much more rosier picture as it comprises the larger companies as well as SOEs. So both remains in the expansion territory, which are above 50-point level, and you can see that the dark blue line, the manufacturing PMI, is actually ticking up. This is because Chinese government has actually rolled out quite a string of pro-growth policies since late last year. So they have actually cut interest rate 3 times, lowered down the required reserve ratio twice, and also they have eased property policies. So in that sense, we'll continue to see service sector continue to outpace manufacturing, and that is actually consistent and aligned with their change of growth models. So they are actually shifting to a more consumption-led growth model as compared to a investment and investment and export led growth model. So on your top right chart is actually the industrial production chart. You can see there's a slight uptick in the light blue line. It actually coincides and supports how the manufacturing PMI is doing. And it has been going on a downtrend due to polluting factories and companies being closed by government on environmental protection. As you know that China is actually experiencing quite a bad pollution at the moment. So environment will be one of their main priorities. On the trade side, as you can see that the dark blue line indicating the exports is still showing a weakening trend. And for the red line indicating imports, we are still seeing that domestic demand continues to slow. The last chart will indicate the consumer side. So for retail sales, they are still quite resilient in the sense that they are still above 10% growth rate. And we do see there's this good news here. There's an uptick. This downward trend is actually associated with the recently intensified anti-corruption campaign. So we are expecting that this anti-corruption campaign will continue the pressure on retail sector, especially on luxurious brands like watch, handbags, wines, fine dinings, as well as the gaming sectors, for example, a casino in Macau. The second drivers in the Chinese economy would be the property market. As you can see, after the big crash here, real estate sector are actually bottoming up. And nevertheless, we would not be seeing that the property sector will have a huge spike here, although that government has relaxed home purchase controls. This is mainly due to there are still plenty of supply in the property market, and we'll continue to see that inventory pressure, continue pressure on the new home price in near term. So probably it's going to go up this way. The third issues would be on shadow banking, as well as local government debt. As you can see from here, the dark bars are actually showing you the local government debt. And it actually ballooned up twice of its size within these 5 years. Apologies because I only have data until 2012 and I don't have the data for the recent years. Anyway, as this has been the main concerns of investors, markets, as well as policymakers, they've made the pledge. The authorities has actually made a pledge to clamp down shadow banking system, and they are really doing so. As you can see that the gray bar here is actually slowing down. This is actually the growth of shadow banking social financing. And another evidence will be on the money supply, the M2. So they are also implementing another fiscal reforms where they are allowing local government to swap their local government debt by issuing municipal bonds. So they are being allocated 1 trillion yuan to roll over their existing debt at a lower interest rates. So with more liquidity on their end, they will be able to implement and roll out more fiscal spending this year. So that brings us to few points where you should why you should consider to invest into the China stock market. There are, there are plenty of speculation that due to weak data, um, the Chinese government is going to roll out more stimulus measures, especially in the monetary policy, because as you can see that the dark blue line here, indicating there are disinflationary pressures and inflation remains low. And you can see the dark blue line here, the real lending rate remains high. So with these two factors combined, it should provide room for further monetary policy easing. And with more liquidity in the system, that should be able to support both equity as well as credit market in China. However, we are not expecting any big stimulus program like what they did in 2007 during the global financial crisis, where they actually rolled out their own QE. This is because that the authorities has actually pledged to stick to their reform agenda, and if they are going to roll out another QE, it will backtrack their reforms. And another point to look into would be the opening up policies that they are so actively implementing and establishing. So the main notable action that they did last year, was to open up the Stock Connect scheme with Hong Kong. So Shanghai Hong Kong Stock Connect will continue to propel the China stock market, and news on Shenzhen Hong Kong Stock Connect, as well as Shanghai and Hong Kong has been thinking of linking up with Taiwan. This news will continue to support the stock markets, as well as create more synergies within the Greater China. Recently, there are also news that they are going to launch this mutual recognition of funds regime in 1st of July, where Hong Kong investors will be able to invest into Shanghai registered mutual funds. Mutual funds registered in mainland China and vice versa. So that should be able to boost demand for A-shares. And we are seeing that free trade zones in Shanghai is expected to expand. And the Belt and Road Initiative, this is actually the main foreign policies for this year, and that should be able to boost fiscal spending as well, and also helps in overcapacity issues, as capital would be able to that should be able to help in capital flow across borders. And there might be a possible inclusion of A-shares into the MSCI Emerging Markets Index, which MSCI is going to announce on Tuesday. Yeah, so please keep an eye on that news. However, we are actually not very positive that A-shares will be included this time round. But MSCI has indicated that they are not going to stick to their June to June annual review. Instead, they are going to look at a more flexible reviews timeline. And another thing is that by investing into China shares, you are actually betting on a long-term currency appreciation. Although that a lot of market participants are saying that China has been artificially depressing their currency, but as you can see from this chart, it's actually the renminbi is actually strengthening, and this chart over here is actually the proof of supporting what this chart is. You can see that they have actually instead of accumulating a foreign reserve is actually going down. And Another news to note and to keep an eye on is that the IMF will consider this year October on whether to include renminbi into the SDR basket. So at the moment, SDR basket only consists of the G3 currencies as well as British pound. So if renminbi is to be included into this basket, it should be able to help and expedite on renminbi internationalization. Yeah. So the conclusion is to cautiously overweight on China A shares, and we're expecting a moderate rebound in the second half of this year. Liquidity instead of fundamentals will continue to drive the equity market, and these are the few sectors benefiting from the reforms. These are the these are the few unit trusts that you may consider to invest in if you are looking into benefiting from the synergies from Greater China. And these are the few ETFs. If you are positive on the China infrastructure sector, you can also invest into these two ETFs. However, these two ETFs are relatively small in their AUM size. So our ETFs colleagues are actually more positive on the broader China index. So, that's the end of our updates on China macro side. So just to give you a brief recap of what happened last week, in particular on Friday. So US actually released their non-farm payrolls. It actually improved, although that unemployment rate and the labor participation rate has actually ticked up. But this actually indicates that US is still on course to reach their full employment at about 5 to 5.2%. So this increases the odds for rate hikes in September. And last week, IMF also urged US to hold their horses until next year. Combined with the factors that US actually recorded a marginal contraction in the first quarter and a low consumer sentiment. Our in-house view is that it was not increase interest rate hike in the upcoming FOMC meeting next week. Yeah, probably it will be on September or at the later of the year. And another event would be on Greece. Greece actually failed to strike a deal with its international creditors. It's actually asking for a postpone of its 305 million euro payment to be bundled together with three other payments, which are going to due this month, to be paid by end of the month at one go. Yeah. So until then, Greece actually has 3 weeks before they become the first country to default in the euro area. Yeah. So this event actually increase the odds for Brexit, and it might induce more capital flows from Greece banks, and which might even lead to bank runs. So these two events would eventually drive the volatility for stock markets this week. This chart actually shows you the timeline for the upcoming events for Greece. So starting from last week Friday, when they missed their payment, and all the way up to 30th, when they are supposed to come up whether they have actually reached an agreement with IMF, the EC, and ECB. So this is the week ahead. Something you might want to look into would be the US consumer sentiment, China's exports and imports, as well as their consumer price index. Yeah. So these are some of the events you might wish to take note of. And that brings us to the end of our presentations. Yeah. So any questions from the ground?
Hi, there's a question on the likely pressure of QNM. It's based on the recent sell-off of the owners. To our understanding, the sale was transacted at about 81.5 cents. So that gives you a discount of 13 cents from the closing of before the halt, which was 94 cents. So right now, the last we checked, the QNM is traded at about 82.5. So one of the key points we'll be looking at on a technical, sort of trading perspective would be 81.5 since that's the price that the owners sold their shares at. The other thing we'll be looking at, which QNM has not given the info for, is the buyers of the shares. Because right now they've only told us that they are looking to sell about 46 million, and we think based on last Friday's volume that they did sold all 46 million. Heritas did a fouling on SGX. They sold 6 million, which is the maximum they can sell. So we think the others probably sold it at that price as well. Has it already sold the amount as well? We do not, however, we don't know who the buyers are, and I think that will be the key concern we're looking at for QNM.
Hi, there's one question on whether we recommend A shares over H shares, even though they are at a premium. That actually depends on your risk appetite and your view on renminbi. Uh, if you are very positive on renminbi and you do hold some renminbi and you would like to accumulate on valuation, so probably you might want to look into A shares. But if you ask me whether to compare the H shares and A shares, I would prefer H shares because fundamentally it's more stable compared to the A shares, as there are more sophisticated investors in the market, in the Hong Kong Stock Exchange, and valuation wise they are cheaper. There's another question on why does Philip view China will not be included into the MSCI index this round? Okay, yeah, sorry that I missed that point out just now. Yeah, there are two main reasons. One is that because we think that the progress for financial reforms and interest rates and so has yet to filter down to the real economies. That might take some time until we see some evidence of the reforms. And another thing is that the stock market is actually currently at what most of people perceive as a bubble. And if they are to include MSCI, if they are to include China into the MSCI index, that would actually um, inflate the bubble, and that would cause some instability in the stock market. So we would think that MSCI would take these two factors into account and might not include China A shares this round. And yes, H shares is already included in MSCI. H shares is actually from the Hong Kong Stock Exchange, and if they are to include A shares, that would include most of their SOEs, some larger companies where they did not list outside of Shanghai. So if A shares is to included in the index, that will actually boost demand for A shares because people who are tracking in the indices will be buying into the A shares. So yeah, that will boost demand as well as increase liquidity. There's a question on why the Shanghai Stock Exchange actually moved up so much compared to the HSI, the Hang Seng Index. So one way to look at it is because that Shanghai Stock Exchange is actually dominated by retail investors as compared to the Hang Seng Index. Hang Seng Index consists of more sophisticated investors like institutional players, fund managers, and more in another way that also there are more risk management tools deployed in the HSI as compared to and on the other hand, Shanghai Stock Exchange actually is highly leveraged, where retail investors are, where you can see that in recent news that there are a lot of margin lending restrictions, where a lot of retail investors actually open up margin accounts, and hence the effect is actually multiplied when they speculate or they pull out from the market. So you see quite a volatility in the Shanghai Stock Exchange. Hi, there's a question on whether is there any reason why that UETF SSE 50 on SGX is not recommended. Actually, the main reason why the list of ETFs are being recommended by our ETFs colleagues because they are they offers a better return and risk adjusted return, as well as more stable in the sense as compared to the other universe. If you're asking on this particular ETF, then probably you might wish to write in to our ETF colleagues who can actually give you a better overview on it. There's a question on H-shares, whether we have any specific recommendation in terms of what stocks to buy. We actually have overseas counterparties who are actually writing on H-shares. So probably you can check out on the H-shares recommendations on our Poems platform. And there's a question on whether is the recommendation to reduce A-share position. No, we are actually taking a stance that to maintain to maintain overweight on the China A shares, but do be cautious of the few risk factors that I've mentioned earlier, and there are going to be quick corrections as well as recoveries in near term, mainly due to Chinese authorities. They are trying to enforce risk management controls. So, especially in terms of margin lending wise. So, in the recent weeks, we have been seeing that the Shanghai stock market has actually corrected like for probably 5 to 6%, but there were quick recoveries. This actually offers you pockets of opportunities if you would like to get into the market. Um, would like to just to highlight again that if you are comparing A shares and H shares, if you are holding renminbi and you are positive on renminbi, then probably you might wish to invest into A shares. But if um, you are looking into a dual listed stocks with both which are listed both in Shanghai as well as Hong Kong, then probably you might want to look into the H shares instead, because H shares are being more stable as well as it's it's cheaper. Yeah. But if you're looking at stocks that are listed only in the Shanghai Stock Exchange, then yeah, bo bian.
Hi, this is Sam. There's a question, what's the likely impact on equity market once US increase their interest rate? Like I mentioned last week as well, that we still believe that the impact will be negative, but it will be short term. So over a long term, the market will be mostly determined by the fundamentals, which are still quite positive. I mean, we had few uh, kind of contradicting data came out last month, but the data coming out this month has been very much positive. The retail sales have been the main driver for this quarter, and we believe that it will remain to be the important driver for the rest of the year. So we still believe that in this lift off is something that we believe is natural, is something that is required. So it will take place hopefully by the end of this year, and the impact will be something that we saw when we saw the first time Fed decided to start tapering. When they first started tapering, the market went down, but then after that, it kept continuing, kept riding on a good fundamental. So like we said, that short term wise, yes, you'll see some sort of correction, but then it will be very short term, and then people will forget. I mean, they will continue to increase the interest rate over the next few years, but we also believe that the increment will be only like 25 basis point, and for this year, and even next year, the frequency won't be too big for it to affect the economy itself. So yeah.
Hi, just to reiterate the point that last Friday's non-farm payrolls actually improved that and also sorry, and also that the unemployment rate is actually at about 5.5 and 5.4 to 5.5. So these two are actually indicating that US is still on course to reach their full employment. So with that, right, it increases the odds that rate hikes is going to happen this year, and they have repetitively saying that they are going to increase it by this year. So like what Sam have mentioned earlier, that our in-house view is that it's going to increase by September or probably later this year. Hi, there's a question on will IMF chief plead to Fed not to increase rate this year, as such action may derail weak global growth. Will this affect Fed's final decision? Um, well, in fact, that actually US has a dominant power in the IMF. So even though that IMF chief is urging US not to increase interest rate hike, but it would be on US favor and to increase their interest rate this year. Otherwise, they are seeing they are saying that their recovery is on track, and further monetary easing might inflate uh, their asset prices. So it will be in their favor to increase interest rate this year. Hi, if there's no further questions, then we will be ending our webinar. And thank you for tuning in, and please join us for next week's webinar. Thank you.